Welcome to Fun with Annuities with your host, me, Stan the Annuity Man, America's annuity agent. Can annuities be fun? Can contractual guarantees be fun? Absolutely they can. Find out the brutal facts about annuities with no sales pitches or high-pressure nonsense. Just the brutal and factual annuity truth, which is all you need to hear. Let's have some fun with annuities, and let's have that fun start right now. Welcome to Fun with Annuities. I'm your host, Stan the Annuity Man, America's annuity agent, licensed in all 50 states. I'm very glad to have a repeat guest on today's program. Backed by popular demand, the top, in my opinion, the top long-term care expert in the country. And if he wants to argue with me, then I'll argue on his behalf. But it is a fact. And his name is Jack Lenenberg. Hey, Jack, how are you?
I'm doing great, Stan. How are you today?
Excellent. I'm looking forward to the topic, which is how to qualify for long-term care and what are the things people need to kind of have in the back of their mind if it's feasible, and the way to go about working with you. And then if you can't find the solution, then working with me. I will have Jack's specific information on my site. If you're driving or if you're on a treadmill, you can go there. If you have a pen and pencil in front of you, his site is, of course, www.ltcpartner.com, ltcpartner.com, all one word, and you can find Jack there. You can schedule a call with him. He is exclusively who I use when my clients need long-term care advice, because he's like me, he's brutally factual. And it's not some sales pitch. He's going to try to help solve what you're trying to solve for. It's not, if it can't be solved for, he's going to tell you. And I think that's refreshing. So what else do you want to add about how good you are, Jack?
Not much, Stan. Thank you for the very kind words. I appreciate it.
All right, let's jump in. Since your last time on the podcast, I mean, phones have been ringing off the hook. People have been emailing me, and of course they've been contacting you as well, which is great. We want them to look underneath that long-term care rock. We want them to understand what's available and what is feasible, and if they qualify, which is the main topic today. I think long-term care is growing every month. It grows in importance when people are looking at their retirement plans. Before we jump into the qualification stuff, Jack, can you kind of weigh in on what you've been hearing, reading, because you are the thought leader in that space, about long-term care and just where we're headed with it as a product?
Well, I mean, everyone is living longer today, and the cost of care is increasing, tremendously, with inflation. So, it's important to plan for it. I mean, so it's on everybody's mind, and there's a lot of states, for instance, the state of Washington just had a long-term care program mandating payroll tax on all employees unless people planned for long-term care. They could get out of the tax. So, there's public programs that are being developed. They're not very good. But the general messaging is everyone needs to plan for long-term care. The states don't have the money. Medicaid doesn't have the money to fund long-term care. So we either private pay or, we can, transfer the risk to an insurance company and take the sting out of the need for care. So
it's here to stay, is what you're saying. The question is how to price it from the carrier
it's not
standpoint.
going away. I mean, we're living longer. 70%. If we have a married couple, the statistics show 70% of people will need some care. In a married in a couple situation. 40% of all individuals will need some care. An average need is now up to 3.5 years. That's an average need. And the cost of care, it's $100,000 a year. So, we either plan for it or we private pay. I mean, that's just the reality of the situation. So
I know that I was on kind of a panel the other day, and somebody kind of threw out there, and I've heard this before, and I've actually repeated it to people at very, very high net worth levels, that if you're at a certain dollar amount investable, not house, car, and art, I'm talking about investable liquid type assets, then maybe you can self-insure for long-term care. Even the ultra rich are buying long-term care because they want to transfer that risk. Is there a dollar amount, Jack, that you think that you say, okay, if you're at this point, because the guy on the panel said 3 million. If you have 3 million liquid, you probably can self-insure. Do you agree with that, or is that just
no.
bunk?
Well, I mean, again, today 3 million. I'd say then my whole book of business could maybe self-insure. Everybody I work with could self-insure.
So that's pretty much the average, right?
I mean, where we're going today. So it still comes down to, do you want to pay for all of the costs of your care should the need arise? I mean, right. I bought my policy, Stan, I was 46 years old. I mean, I could self-insure easily. I don't want to self-insure. I just don't want to do it. I wanted a policy.
Sure.
I wanted to have a plan in force so that my kids will not have to be burdened with any of these issues. In 30 years, they're going to have enough, responsibilities of their own at that time to not worry about, mom and dad. I just wanted to be responsible to my family and have a plan. And, certainly if I could self-insure and write a check for $100,000 a year to pay for the cost of my care, certainly I could actually afford to, buy a plan and write a check for a premium as well. So I think it really comes down to, do they want to have coverage? Do they want to have a plan? Do they want to, for whatever their reasons are, whether it's not burdening, a family with these issues, protecting assets to possibly leave a legacy. So there's many reasons why people plan. But as far as, can people self-insure? Sure. I mean,
it all comes down to risk tolerance, I guess, and just kind of what you're doing. Jack, one of the biggest misconceptions that I think the long-term care industry and it also the annuity industry suffers from, and it is a misconception, is I'm going to set up this long-term care plan with Jack Lenenberg, the top long-term care expert in the country, but if I don't use it, money goes poof. Please explain and clarify and pound the table and yell into the microphone that's not true, and you can set things up so that 100% of the money goes to somebody in your family if you don't use it.
Well, true. I mean, so there's different ways to fund the plan, right? We have the old way of doing it. The traditional way was you just buy a standalone long-term care insurance policy, and you pay premiums monthly or annually for the rest of your life. And if you don't need it, well, yeah, you pay for insurance, and the money went away.
What is what percentage of the marketplace does that product represent right now in your guesstimate?
Wow, a lot lower than it used to be. It might be down. I mean, it might be down to 20% today, 25%, okay. Where it used to be 100, right?
Right.
So now the market has completely shifted. So the other way to plan, policies are called asset-based policies, where they combine the long-term care benefits with a cash value policy, an annuity contract, or a life insurance policy, such that the money that you pay for your plan, if you don't need care, comes back to your estate at your death. Generally with most of the plans, the money that you put in, all of it will come back.
Repeat that again. I'm going to interrupt you. I need you to repeat exactly what you said again, because I can't tell you how many people call me, and I can't imagine you get it. I mean, just repeat that again, that you're placing your money there. Yes, you're getting long-term care coverage, but if you don't use it, money comes back to you or your beneficiaries. Say that again.
Well, so we're repositioning the premium, and we're growing the money for long-term care. We're not growing the money, for investment gain. We're repositioning money, growing it for long-term care if care is needed, but if not, the insurance company returns the premium at death, 100%. So, essentially, you win in three ways. I mean, if you live too long, you have long-term care benefits, tax-free. If you die, money comes back for the death benefit. And with a lot of the plans, even if you change your mind and you quit, you get the money back. They have, cash surrender value to where if you change your mind, you can get some, or, well, a few companies still will give all of the money back, but that's been changing recently. But yeah, the plans are completely flexible. Benefits are guaranteed. Premiums are guaranteed. And if you don't need care, the money comes back to the estate. So with my high net worth clients who have assets of $3 million, or more or less, again, there's no risk to the plans because we're just taking money from our right pocket and putting it into our left pocket. It's still our money. But if we need care, the insurance company, puts in their money. And there's plans that provide lifetime unlimited long-term care coverage forever if you need it.
So when people go to ltcpartner.com and they contact you, they just need to be very, very specific on what they're going to what they're trying to achieve and what their hopes and wishes are for the product. You're going to tell them whether it exists or not. And if it does, you're going to quote all carriers. If it doesn't, you're going to tell them, you can get close to what you're dreaming of right here. But once again, you're kind of looking at it as a commodity product. You're quoting all carriers?
Oh, everybody. Yes. All types of policies, traditional policies, the asset-based policies, whatever my clients want to consider, I can show them what the rates are based upon their age, based upon their health, for any policy.
Well, why would somebody choose that traditional policy, Jack? Why would someone choose that? Why would someone choose the traditional policy, the one that keeps lowering, the people who are buying it, the percentage lowers every single year? Why are people choosing that?
Well, it's, some people are more comfortable with just, let's say someone has not a lot of liquidity, for example, right? But maybe they have a pension, $8,000 a year, and Social Security on top of that. So maybe their strength is just guaranteed income, right? And they might not have the liquidity to maybe use towards an asset-based policy. Well, for someone like that, a traditional policy, if it's $500 or $600 a month, and they know that they have $10,000 a month of income for life, they could reposition some of their income and get the coverage very easily. So, and then some people don't mind just paying for insurance, right? We have homeowners insurance, auto insurance. We write a check. If our house doesn't burn down, we don't get anything back. So, there's nothing wrong with a traditional policy. The risk with the traditional, the one risk, the insurance company could change your premium. That's the risk. So a premium could change. So you're getting into a contract on a traditional policy with the insurance company where they could increase your premiums. And that's what a lot of my clients are concerned about with the traditional is the fact that the rates aren't guaranteed. Medicare supplement rates aren't guaranteed, right? Health insurance rates aren't guaranteed. It's not anything different than other policies that people have, but I guess that's their concern. Where the asset-based policies, everything's guaranteed. The premiums are guaranteed; they can't change.
So with the traditional policy, and then someone that fits that mold, they don't have a large liquidity, they have an income stream coming in to cover it. The concern, and you tell them up front, is the potential for the increase in premium. And we see that. I get those calls a lot, pass them to you, obviously, that, they're raising it. What do I do? What's your answer to they're raising it, and what do I do?
Well, if anyone's owned a policy, if anyone's owned an older policy that has had a rate increase, they're sitting on gold. I mean, just sitting on absolute gold. Even with the rate increases, they need to, I mean, in my mind, just write the check, pay the premium, don't change their benefits at all, because they're in definitely a position of strength if they have an older policy that was written between the years of 1995 and 2013. Like, those old policies are gold because they were priced too low. So, and we get a lot of calls as well from individuals nationwide who are getting rate increase letters, and they've owned the policy for 10 or 15 years, and now they're dying to make changes, and it's not the time to make changes. They're older now. What they own is irreplaceable. I mean, it would cost tens of thousands of dollars more to try to buy anything new today. So they really just need to work within the plan that they have, and either pay the increase or modify the benefits within the plan that they have. The newer policy, I mean, the policies written today, the traditional policies, are much less likely to have rate increases than the older policies, because we have rate stabilization guidelines in effect now on the traditional policies today. So they are much less likely to ever have the rate increases.
That's interesting. I didn't know that. Let's stay in the traditional for a second. Qualifications. So what someone fits, you've talked to them, they have that income stream flow that can cover the monthly premium. They don't have the liquidity to go and do an asset base. It doesn't seem appropriate and suitable. What are we looking at from the standpoint of the underwriting process? Can you walk the listeners and viewers through that?
Yeah, absolutely. So, and the different types of policies do have some different underwriting. So the hardest policy to qualify for will be the traditional policy. All right. So all the traditional underwriters today have a consistent underwriting protocol.
Why is that? Hold for a second. Why is that? Why would the traditional one, which seems to be the one that where the money goes poof, right? If you die, you don't use it. Why is that? Why is that more difficult to get? Because you're using less money for more benefit?
Well, okay. So think of it this way: a traditional policy. Someone writes a check for $400 a month, right? And let's say the underwriter got it wrong, and after 5 months they're on claim. The underwriter collected $2,000, and now you are immediately in their pocket. No more premiums, and you've got, $700,000, $800,000 of coverage or whatever you bought, and they owe it to you for a couple of monthly checks. The asset-based policy, I mean, even if they get it wrong, they're still using the asset for the first 2 years of claim. So they're still hedged. They're still hedged. Even if they really get it wrong, they still have a hedge. They don't want to get it wrong. They're going to underwrite both, they will both underwrite. They don't want to get it wrong, but there's no hedge on the traditional. So the traditional underwriter is not going to take any underwriting shortcuts whatsoever.
Okay.
They never will. So here's the process with the traditional. If you are under age 65, telephone health interview, it will last 45 minutes, and they will do a prescription drug report up front. So they're going to see all your medications. They're going to know what you've been treated for. So when they're interviewing you, you can't not tell them something. They kind of already have their information. And they're going to order medical records from your primary care physician and any specialist that you have seen within the last 5 years. So they're going to get all of your medical records within 5 years.
Okay.
They're going to interview you over the phone, and they're going to do electronic prescription drug report. Okay. The telephone interview over the phone, they give a memory test. Now, for individuals under 65, usually not that complicated. But that's the process. They're going to do full medical record review. So generally speaking, everything will come out in the wash on the traditional application. Over age 65, they're going to meet with you face to face and give you the cognitive screening test at your kitchen table. Okay?
So they're doing everything but the phone, and they're replacing the phone with a face-to-face when you're over 65, right?
Over 65 is going to be a face-to-face. Yes. But and they're going to get all the medical records.
Sure.
So a traditional policy, now there's no exam, right? There's no exam. They do require, to even apply, they do require that you've seen your doctor within the past 2 years and you've had full labs in the past 2 years.
Whether you're below 65 or above 65.
That's right.
Okay.
I can't tell you how many people will call me and say, I'm healthy. When's the last time you saw your doctor? I don't see a doctor because I'm healthy. How do you know you're healthy?
62.
How do you know you're
1962.
So again, they want a recent exam, a recent checkup within 2 years, with labs, the traditional underwriter. They will require that. So, it's not easy to get approved for the traditional policies because there could be a lot in your medical records, So on average, they decline 30% of applications. On average.
And how long does that, you can't pinpoint it, but give me a range. How long does that process typically take from start to finish?
6 weeks. Traditional is 6 weeks.
Got it. And when you interview people and they call you, just like people schedule a call with me and we talk annuities, they're going to schedule a call with you and talk long-term care. If they're leaning toward the long-term care, I'm assuming you're going to ask some pre-qualifying questions. Can you steer people away from that if you feel like it's going to be not approved or, quote unquote, a waste of time?
Well, at the end of the day, I pre-qualify everyone. Yes. I mean, so I will let everyone know up front if we can submit an application and if we're likely to be approved. So it's, everyone I speak with, I'm trying to gather as much health information up front so that I can make proper recommendations on not just which avenue we have to go, but I mean, even within the avenues, the underwriters are different. We could have one traditional underwriter, for instance, hates depression, just hates any medications that deal with depression, anxiety. Another one doesn't. So again, we have to know which underwriter to go to, even within an arena, based upon the health history. So it's a challenging process, especially with traditional, because they're always getting medical records. And sometimes even when I speak with my clients, they don't know everything that's in their medical records.
Got it.
Or they forget that they talked to their doctor about something, or so sometimes they don't always share everything with me up front that's in their records for whatever reason, maybe a lack of knowledge. But it can be a challenging process if there's information that's adverse within medical records. The hybrid asset-based policy approval process is so much easier.
Yeah, let's stay on the traditional for just a second. I'll ask a few more questions, then we'll go to the asset-based. So people need to understand when they speak with Jack or myself, first of all, everything is confidential, non-shared, non-sold. All information, we're very serious about that. So you need to know that up front. So you need to be upfront with Jack when you talk to him, and he's gonna bring that out of you anyway with his decades of experience. And I think you've heard kind of the reason you need to interact with Jack is because he knows who to work with, how to work with these carriers to get you approved. He certainly can't guarantee approval, but he can give you guidance and a reasonable expectation of what would happen. Am I correct about that?
Oh, absolutely. I mean, everybody's time is valuable. My client's time is valuable. We don't like to create false expectations. I'm very good at what I do. I generally get approvals. So, but I pre-qualify everyone because I just, I don't want to have anyone get declined. I want positive outcomes. So
And don't get mad if Jack tells you that you can't qualify based upon his experience. He's trying to help. That's also trying to help as well. So that's the traditional side. I think it's very interesting. A couple of things that you said, which is, it's still there. And I thought you did a fantastic job explaining who it's for, which is that person that doesn't have the large liquidity to do an asset based and that can afford it. And the reason I thought was fascinating, which was the reason for the stringent underwriting with it, is because the carrier, the issuer, has to get it right, which leads you back to why you should keep the traditional long-term care if you've owned it for a while, which I thought was good. So anything to add on traditional before we head toward the asset-based? Anything we forgot?
No, it's just a very constant, more than anything, it's a very concentrated arena. There's only a couple of underwriters left. So
Got
that's,
it.
Again, it's concentrated arena, challenging arena, but it's absolutely still has its place, Stan. Absolutely.
You just really tied a nice little bow to that one. Let's transition to the first type of asset, and I want to take them in tranches. So we've covered the traditional. The second one that you primarily work with is a asset based with an annuity chassis, for lack of a better phrase. Can we go down that path to talk about that? Because let me give some background to the listeners and viewers. Annuities are issued by life insurance companies. Long-term care annuities are issued by health insurance companies, correct?
Yes. Well, no. I mean, it depends.
That's why you're here, Jack Lenenberg.
I'm thinking that, again, the long-term care annuities is also a fairly concentrated arena, and one of the bigger players is a life insurance company. It's a life insurance company.
So let's talk about the asset-based care with the annuity chassis. Mm-hmm. How does that underwriting work, Jack Lenenberg?
It's the easiest on the street. So where traditional is the hardest, the annuity long-term care policies, telephone interview, generally telephone interview only. And I can get an approval in a day with one of my underwriters in a day. Telephone interview, 45 minutes, prescription drug report, cognitive screening. That's it. They will generally never order medical records on the annuity approach.
So you control the asset. Explain broad-based, because every carrier is different, the type of coverage on an annuity chassis that's offering this long-term care coverage.
Okay, so as a general rule, they're going to multiply the money that we deposit. So a common approach is triple your money. You write a check for $100,000. Today you have $300,000 for long-term care. You write a check for $200,000. Now you have $600,000 for long-term care. Okay, you can buy individual policies. You can buy joint policies. Cover a spouse. So they will triple your money, and then they will provide you long-term care benefits on an individual basis. For 6 years of coverage is a standard plan. Mm-hmm. Joint policies, you can share 7.5 years of coverage
between the two of you.
Between the two, right? So we're going to multiply the money. If care is needed, long-term care benefits are tax-free. If care is not needed, the money that you put into the annuity comes back to your estate as a death benefit. Typically there can be a little bit of growth on the money, but it's not an investment play. It's really a play for the extension of benefits through long-term care riders. So that's the purpose of the plan. And we're not going to be making 5 or 6% on the annuity.
So the accumulation value on that is like buying a bad CD. You're going to get a small interest rate on that amount of money that you could walk away with in the future. Would that be a simplistic way to put it? Is that right?
Yeah. I've got one underwriter now paying 3%, which is good.
That's real good.
It's just not guaranteed, right? You know, it's not guaranteed. They could change that to 1% at their discretion.
Sure.
So, and again, there's costs of insurance that's coming out of the crediting interest anyway. So it's you're getting credited, but you're getting debited. So the cash values.
It's a wash.
It's a wash. You might get some gain, but nobody's doing it for the gain of the cash values. They're doing it to turn $100,000 into $300,000 immediately for long-term care.
Now,
that's why they're doing.
Now, you said they could change the interest rate crediting rate on the accumulation value, but they cannot change the long-term care coverage once you lock that in, correct?
No, everything's guaranteed. Everything's guaranteed. So
the person that would choose that option.
Yes.
Why?
So these policies will be the best for applicants in their 70s, older applicants, or possibly due to health issues, underwriting issues, if they might not be able to qualify for the other type of asset-based policy, which is tied towards a life insurance policy, not an annuity.
We're getting ready to talk about that one. What's the minimum? Is that a deterrent?
The minimum
premium, because you're going to lump sum it. This isn't flexible, correct? This is a lump sum product, correct?
Well, single pay annuities, the life insurance policies, I can spread premiums out over 5 or 10
Gotcha.
years. Yeah, but so single pay, but assuming we're going to write a check for a single premium, the annuity contracts are priced really well for individuals in their 70s or individuals who might have some health issues that might not allow them to look at other options. Or it's a great fit for someone who might have gains in a non-qualified annuity, significant gains over basis, and they want to do a 1035 exchange. And then if they need long-term care, all the gains come out tax-free.
And for people, what a 1035 exchange is the IRS ruling, if you're so bored with no life and you want to look it up, Section 1035 says that you can take a non-qualified, non-IRA annuity using non-qualified assets, and you can transfer it without tax consequences, non-taxable event, to another annuity. That's the IRS 1035. So when you hear people say 1035 exchange, you're exchanging an annuity to another annuity, but you're not paying the taxes. Go backwards a little bit, Jack, and talk to people about what you just said quickly, but I pulled that gold nugget out about an annuity with some gains in it that you want to transfer to this. Say that again.
Well, sure. So if someone has, say they bought an annuity, 20 years ago, and they deposited $50,000, and the annuity is now worth, with gains, $220,000, and they're sitting on, $170,000 of taxable income. They could do a tax-free exchange into a long-term care annuity. And turn 220 into immediately, for example, 660,000 that if they need care, it is all tax-free. All those gains will be washed away through tax-free long-term care benefits under the Pension Protection Act. So,
all right, hold it for a second, because we got to let the people that just fell off their treadmill and pulled their car over just to regroup just a second. Because what you just said applies to a lot of people that say bought a variable annuity a long time ago and forgot about it, and it's just kind of grown, right. And they can transfer it without tax consequences, and then reap the rewards of a tax-free long-term care benefit by multiplying that asset again.
Oh, the leverage is incredible. It's incredible to do that. There's a lot of individuals sitting on gains inside non-qualified annuities, going to be taxed at ordinary income. They have a need for long-term care. They want long-term care. We simply do a tax-free exchange, and then if care is needed, it all comes out tax-free.
That is beautiful. Now, if they don't use it, they transfer it 1035 over to the long-term care annuity, and they don't use the long-term care.
Well, Well, the basis gets transferred over. So again, still in the same position.
Got it. Now, you can use IRA assets for these long-term care annuities, correct or not correct?
I have one underwriter, yes. One underwriter, yes. Yes.
How about Roth IRAs, Jack Lenenberg? Roth IRAs.
Well, Roth is, you can just withdraw the money with no taxable.
Do people use Roth IRA money with you occasionally?
Well, yeah. I mean, Roths present no problems.
Sure.
Because we can withdraw the money tax free. But a traditional IRA, I have one underwriter that will accept traditional IRAs. So
traditional IRA, Roth IRA, the sweet spot is non-qualified annuity transfers if you can do that, but you can also just take checking account money and get this as well. And once again, the underwriting process is not full underwriting, but phone, correct?
It's simplified telephone interview, easy process, a very easy medical questionnaire that we just, complete up front. It's a yes or no questionnaire. And if my clients answer no to all the questions, they're going to be approved. And it's a very easy process to get the long-term care annuities. Extremely easy.
So we've got the traditional that takes 6 weeks, and they're going to look at you with a fine-tooth comb, as they say. Then you have the long-term care annuity, which can be approved in as soon as a day.
Yes.
If all of everything's lined up, and Jack and his staff will certainly do that for you if that makes sense. And then before we move on to the form of asset care that I want to talk about, just remember, everyone listening, if you have that non-qualified, non-IRA, non-qualified means non-IRA for everyone out there that doesn't know that, non-IRA annuity with some gains inside of it, and you're really not sure what to do with it, and you need long-term care coverage, just remember, this could be the best podcast you've ever heard. And yes, I do accept thank you notes and Omaha steaks. Jack does too. That this might be a place for you to at least contact Jack and say, you know what? I got this variable annuity and I put 50 grand in. It's now worth 300. Me and the missus, me and the wife, whatever, need to get or look at long-term care. This could be a very simplistic and quick way to do it if you qualify, correct?
Correct. And you don't even have to exchange the entire amount. You can do a partial exchange. If you have, 50 into
Beautiful.
300, you could end up deciding to just transfer half. Keep half in the variable annuity that you have, transfer half over into the long-term care annuity. So,
that's
very
fantastic.
Flexible options.
Jack, you just get better looking to us with each podcast recordings. Phenomenal. Let's transition to the third one I want to cover. And I think this is, maybe you can correct me, but these are kind of the 3 tranches. Am I missing something getting ready to go to the third one? We have
Not
3.
missing anything. There's 3. Correct.
Okay, here's the third one, everybody. So rev that treadmill up, or car, whatever you're doing. It's asset-based life insurance that has long-term care coverage. I said a lot there, Jack, and I said it slowly. Let's dig in. Let's talk about how you qualify for that animal.
All right. So the asset-based life insurance underwriting is similar but more comprehensive than the asset-based annuity underwriting. So for the most part, the asset-based life insurance underwriters, they will start with the telephone health interview. That's where they'll start. 75% of the time, we'll get an approval right after the interview. So it can be very similar and as easy as the annuity approach. However, if during the course of the interview, they feel that they need to gather and obtain more information at their discretion, they can order medical records. And if they're ordering medical records, now we're probably down to a 50-50 shot of getting approvals. So
how long's the process? It could be a day up to what? If they start digging in, how long does that take?
Yeah, so it's again, now we're at the mercy of our clients' doctors. So anytime there's medical records, because just like the traditional underwriter always orders medical records, so the average time is 6 weeks, it's because they always order medical records. So we're just at the mercy of the specific doctor's office and the copy service that they use. And sometimes we get the records in 2 weeks. Sometimes it could be 4. Sometimes, well, it could just be longer if
you got to get in the car and go get the records.
Yeah, so it's a process. I would say though, on average, 4 weeks.
4 weeks if they dig in.
If they're ordering, if they need the records.
If they need the records, it could be quick if they don't, right?
Oh yeah, I mean if they don't, the turnaround time for these applications is usually 5 to 10 business days at most.
So you have a life insurance policy, which we all know that's the best legacy product ever, because the death benefit goes tax-free, probate-free lump sum to the beneficiaries. It's the best, as I tell people, it's the best return on investment you will never see because you're dead. Tell us how inside of that policy, Jack Lenenberg, how does that long-term care coverage work?
Well, it will depend upon how we design the plan. Okay, so but it's going to look a lot like just a traditional long-term care insurance policy. Monthly benefit, how much per month do we want for long-term care? Benefit period, how many years of benefits are we buying? These policies are typically 6 years of benefits or lifetime unlimited. And inflation protection, are we growing the money to keep up with the rising cost of care? So the planning with all of these long-term care policies really just revolve around the same 3 issues over and over again. How much per month do you want for the cost of your care? How many years of coverage do you want? How much inflation protection do you want? So the benefits are going to be designed around those 3 factors.
Say those again, Jack, for the people. Say those 3 factors one more time.
3 factors. Monthly benefit. How much do you want your check to be every single month if you need care?
Mm-hmm.
Okay, whether you're in your own home, whether you are in assisted living, room and board,
mm-hmm.
whether you are in a nursing home, what do you want your monthly check to be every month, tax-free? So that's the first piece of the puzzle. Second piece of the puzzle, how long do you want your monthly check to come to you? How many years do you want in your plan? Average stay is about 3.5 years. 85% of individuals will need care for less than 6 years. 15% of people will need care for greater than 6 years, Stan. Cognitive issues.
That's a lot. That's higher than I thought. That's a lot.
Oh yeah. It's why a lot of underwriters don't sell lifetime unlimited benefits anymore. I have 2 underwriters that do still sell lifetime unlimited. 2 underwriters that do, and one of the underwriters, it's priced very well. The other one, it's not. So nobody buys it, even though it's offered. But I have one underwriter on the asset-based side still offers unlimited. But that's so if my clients, if they're concerned that 3 or 4 or 5 years of coverage isn't enough, we just
And then the third thing is what?
Inflation protection.
Oh, you're just singing everyone's song out there, Jack. Remember I told you you're getting more and more attractive. At this point, you're the Brad Pitt of long-term care, for gosh sakes. Inflation. Let's talk about that. How's that work?
Well, if we buy a monthly benefit today, and if it doesn't have inflation protection, right? So if we buy $5,000 a month in coverage, and we need care in 20 years, we still have $5,000 a month. If we put inflation protection in the plan, we're going to have $9,000 a month instead of $5,000 in 20 years. It automatically grows your money, guaranteed, by the inflation factor that you choose.
So this is a customizable product.
Everything is customizable.
This is customizable. This is, hey, Jack, I wanted to do this. I want this amount of money. I want it to increase with inflation, and I want it to last for this amount of years or for life. Jack Lenenberg, go find it for me. Are there a lot of asset-based life insurance carriers doing this? Is this the sweet spot out there?
It's totally customizable. There's a price for every seat on the bus. Wherever you want to sit, there will be. You can sit anywhere you want. Design your plan however you want.
Yep.
And there's a different premium for every seat on the bus.
Now, Jack, my Learjet hits the mountain. I'm in my Learjet. I just bought this from you, right? I rented the Learjet from NetJets because it's a Warren Buffett-owned company, as you know. And it hits the mountain, and I die. What happens to the money, Jack?
Tax-free to your estate, Stan.
My goodness. So, what else am I missing from the standpoint here? So you can get it done as soon as a day, or they dig in and do some underwriting, which then lessens your chance of getting it. But it's fully customizable from the standpoint of amount of money, inflation, and length of time.
Right. Yeah,
what am I missing, Jack? What am I missing here? You're king for the day here. That sounds good.
Yeah, it's what everybody's doing today. Everybody's doing these types of plans. Everybody. Repositioning assets, inflation adjusted long-term care benefits, if that's how we design it. Yeah, and some policies look good some look good with inflation, some the way they're priced look good without. But however we design it, you can get lifetime unlimited benefits if you want it. And if care is not needed, the money comes tax-free to the estate. And we can use IRA and 401k rollover money for these plans too.
So non-qualified and IRA and 401k. So it's certainly, worth, connecting with Jack. And the reason we're doing this podcast is I got a lot of people saying, well, that sounds great, but I need to know more about the qualifications. I think we've done a pretty good job. I'm patting myself on the back a little bit, and you too. I can't reach that far in Atlanta. But I think this helps people. Now let's go to the dark side just for a second, Jack. Somebody calls you up. They get Jack Lenenberg, the top expert in long-term care in the country. It's not even an argument. And he comes back and is brutally factual because he is brutally factual and honest. And he says, I can't help you with the darn thing because you're smoking you're smoking a carton of cigarettes every day and drinking 2 bottles of Jack Daniels. But that doesn't make you a bad person, but you might not get coverage. Now, the dark side is there is an annuity that has a guaranteed issue kind of doubler that if you go to the bad chicken dinner seminar and the guy stands up there in a bad leisure suit and says, I can get you upfront bonus and index annuity and long-term care. Number one, all that's crap, okay? But it is the last resort if Jack can't find something for you. And typically in my world, they call them income doublers, where it's an income rider where if you qualify, they just double the income for a specific period of time. But I don't want to spend much time on that, Jack, because I want the people to know that if they're calling for long-term care, if they're going to call me for long-term care, I'm going to refer them to you. You're going to exhaust those 3 tranches: traditional long-term care, annuity long-term care, life insurance with long-term care. If you can't cover them, then you'll come back to me and say, Stan, they can't qualify. Then at that point in time, we will visit an income rider with what's called a confinement care benefit. It is not long-term care, it's confinement care. That's what we've been doing, Jack. I just want to let people know that you're going to hear things at the bad chicken dinner or expensive steak dinner seminar that sound fantastic, one size fits all. It is not. To get a good long-term care coverage product, you are going to have to go through some underwriting. Do you agree with me, Jack Lenenberg?
Oh, some underwriting, yes. And again, it can be really, really easy or really, really challenging, just depending upon the health history of the individual. But I can usually, within about 90 seconds, know everything I need to know regarding, will I be able to get my client approved, declined, which policy will be best. Minute and a half conversation, and I'll know everything I need to know generally.
Next time I talk to your wife, I'm going to say, 90 seconds? Did you fall in love with this cat in 90 seconds? There's no way. I kid. Hey, Jack, what have we missed? I think we've done a pretty good job covering this, and I want my listeners and viewers to feel comfortable to contact Jack or myself. If you haven't caught it yet, we're kind of old curmudgeon-y dudes, been doing this a long, long time. There's no, we have cowboy boots older than most advisors that are out there. Don't hesitate to contact us if you want to look under the rock and see if this type of coverage works for you. But if you've been looking for that long-term care person that you can trust, guess what? You found him. We're going to keep putting him on the program to explain these products over and over and over. What specific things do you think we missed, Jack, or were we just fantastic?
Well, I think,
killed it?
I think with long-term care underwriting, I think where individuals misunderstand whether or not they're going to be approved or declined, the common comment I get when someone calls me initially is, I have no cancer, I have no heart disease, I have no diabetes. It's like everybody wants to tell me that. I have no cancer, I have no heart disease, I have no diabetes. It's like, okay.
Fantastic.
What do you have? What do you have?
Tell me more.
Everyone thinks like they're automatically going to get approved. I have no cancer, I have no heart disease, I have no diabetes. What do you have? Well, and then we dig deeper, and it's, I have, physical therapy, and I've had some injections, the
Sure.
last few months,
Sure.
and try to control the pain, things like that. Things that they think are no big deals, that are huge deals for long-term care underwriting, just absolutely huge.
And they
deals,
will find out.
Yeah. I mean, breast cancer, a year ago, 2 years ago, prostate cancer, like nobody cares. Nobody cares about stuff like that. They will give you your policy. A heart attack 10 years ago, you will get your policy. Ongoing physical therapy with injections, right? Very challenging.
Mm-hmm.
Osteoporosis with a history of a fracture, right? Where my clients want to tell me, why they slipped and fall, what they were carrying down the steps, and give me. Underwriter doesn't care how it happened. They care, did you fall?
See, I would say, listen, it was my wife's fault. She was talking to me while I was trying to focus, and then I turned 3 flips and hit my head.
Right. But they're looking. So the long-term care underwriting is all about stability and control. You're allowed to have issues, but are the issues managed? Stable, non-progressive, right? Stable and controlled. That's what long-term care underwriting is. Stability and control. If they're not stable and they're not well controlled, the underwriter will say, come back to us in 6 months or 12 months after you show us a history of stability and control. So that's what they're looking for, and there's just a lot of issues that revolve around muscles, bones, joints,
Mm-hmm.
depression, anxiety, chronic fatigue, fibromyalgia, stuff that has nothing to do with cancer, heart disease, and diabetes.
Well, I think it's important for people to, when they go to your site, again, ltcpartner.com, and connect with Jack, put your fists down, put them down, get your defenses down, have a conversation with Jack, be very honest, upfront, and forthright with him, and he can find the solution for you if there is a solution to be had. But go in it, not trying to hide things, go in it open and have him, he's the top guy in the country. Have him look at it. He represents pretty much every carrier out there, if not all, and he's going to find the best contractual guarantee and the customized solution based on what you tell him and based on your situation. I think it's important, Jack, that we found out today that you are the Brad Pitt of long-term care. You just get more and more attractive with each time we talk to you. Any last items before we close this wonderful podcast out?
I just want everyone to remember, you buy long-term care insurance with your health. That's what you buy it with, your health. You may pay for it with your money, but you're walking through the door of approval with your health. So it all comes down to underwriting.
Perfect.
It all comes down to underwriting.
Hey, Jack, you're going to be on another podcast, whether you want to or not, because the people still need more from you. This has been a great, if you haven't listened to Jack's first podcast with us, go to my site at theannuityman.com, and under podcast, you'll see the list, and he'll be there. we're going to post this one as well. Jack Lenenberg, it's always a pleasure. I consider you a friend and respect you as the top expert in long-term care in the country. Thank you so much for joining us.
You're welcome, Stan. Thank you for having me once again. Always a pleasure being with the top annuity expert in the world. Not the country, the world.
There you go. And for everybody listening to this podcast on all major platforms and viewing it on the YouTube channel, Fun with Annuities, I want to thank you for joining us, and I will see you next week. Thanks for listening to Fun with Annuities. Please hit the subscribe button and make sure to go to my site at theannuityman.com, where you can run your own SPIA, DIA, and QLAC quotes and see a live feed of the best MIGA fixed rates in the country, and even get indexed and income rider quotes as well. You can also sign up for my 6 annuity owner's manual books, and I'll ship them for free and under no obligation. I also encourage you to schedule a one-on-one call with me, Stan the Annuity Man, so we can have a full discussion of your specific situation. It will be the best brutally factual and truthful advice you will ever get, and that's one guarantee you should definitely take advantage of. So join me next time for the #1 annuity podcast on the planet, Fun with Annuities.